Hello YouTube, this is Alex, and in this video I'm going to show you how to be efficient shorting stocks. So this is only the 15th. The Federal Reserve just decided to cut rates to 0. So let's see if there are opportunities to short, what would be the best way to do it. And here I am in my TD Ameritrade account, and I am gonna use an example of General Dynamics that I did. And the trade that I made are this one. These are the trades that I made. I'm gonna discuss it in a little while, but just I'm gonna explain why I think this is a better way to short the market or any specific stock. So if you were going to short, this is at the time of the trade, the price was around 183. So that's why I have in this price around here, so that I can show you how it was. So if I were gonna, I did 4 contracts. So if I were gonna short 400 stocks, this is how it would looks, and this is the price. So if we get a 15% down move, I will be making around $11,000, and if it goes up, then I will be losing the same amount if we go up 15%. The important thing is that, of course, if we short the stocks, we have unlimited risk to the upside. So here with 15%, I'm only losing 10,000, but if we continue to go up, you can see the amount I'm still losing, and if in theory, you know, I can lose my whole account. Another thing that is very bad about doing shorts like this is the buying power effect that it's gonna have. If you see here, if I do this trade, it will be around $84,000. In reality, it will be less, around half in a margin account. So let's say around $40,000 or so will be the capital requirement for this trade. So it's not really capital efficient in terms of if I want to make this trade, I need to put a big chunk of money in this kind of bet. So the best way to do it is using options. And what I did is I bought an in-the-money put. So for example, the price at this moment was 193. So what I did is I bought the 205 put. So this is an in-the-money put. And the reason I did it is because this is kind of a synthetic short. So it will simulate almost the same movement as the stock, but it will be a lot more efficient in terms of the capital that I will be using. For example, I bought 4. So here again, this is the trade I made. Here the 1, 2, 3, 4, and the price was 22.80 at that date. And that means that for this specific trade with 4 contracts, the maximum loss that I can have will be $9,000. So again, with that same movement, when I went with the stock, I will be losing $11,000 and winning around the same, right? Around $11,000 too. And in this trade, if I lose, I will be losing $9,000. Doesn't matter what else. If it goes up 20% or 30% or anything above this price, my strike price will be my max loss. So it will be capped. But to the downside, I can still continue to make money. It doesn't matter what. If it goes to 0, then I will continue to make money. So to the downside, to compare it again, then I'll be making $11,000 or around $11,000. So very similar to the other trade, but limiting my loss. Also, my loss, which will be $9,000, is gonna be how much capital I'll be using. I don't need anything more than that. So instead of $40,000, I'm using $9,000. So way less capital with less risk, and basically the same kind of reward. So what else can we do with this, right? So if I'm wrong and it starts to go up, let's say you have a stop loss with using your favorite technical signal or whatever, or let's say you have a stop loss at 190. So when the stock is at 190, because this is a long-term option, at that time it was like 90 days or so in terms of the expiration. So you're not losing one for one the same as the stock. You're actually losing a little bit less. So even if you're wrong, you can close it out. If you don't like that trade anymore, you can close it out and you will be better off than when you short the stock straight away. So that's another benefit. But a better benefit is what you can do when you are right, because you can reduce your cost even more. So what happened? What I did, if we go to the using SyncBank at this state, at the 27th, I did my first adjustment. So at the 27th of February, the price was at 166. So right now, if we go here to 166, so already I'm making money in this trade. So I can do a couple of things. I can decide to just close it out and take profit. It will be like 7,000 out of 9,000, so around 80% return. So that will be a great result. But what if I want to continue to get short or leave it right there? Well, the thing that I did, thinking that the market was continuing to go down. So what I did is I roll down the put, and what this does is I get a credit and I reduce my risk. So instead of risking $9,000 when I roll it down, now I'm risking $2,000. So I reduce my risk by 75%, but I still have the capacity of make almost the same amount of money. I'm reducing my max win by a small percentage comparing to how much I am eliminating my risk. But then it continued to go down and we started to have the crash. If we see here again, this day we had a negative 3%, and the next trade was actually the next day. So on the 28th, again, we have almost a 4% move, and I did the same thing. And right now we will have 77 days to expiration by this time. So I did the next trade, and again the same thing, and now I am risk free. I am not risking anything. And if we go up, then my original trade will continue to make money, even though I will of course lose what I'm winning at this moment. There's no more risk, and I can continue to do other trades with my portfolio and don't without worrying about this specific trade. And of course, then we have more movement to the downside, and the next trade was on the 12th. So let's see what happened. This was last week, and of course we got an 11% down move, and this is where we are right now. So the stock price was around here. What I did is I rolled down again the put price, and now even if we get a big move to the upside, I am guaranteeing a 7,000 profit. So what happens if we continue to crash? This is the expected move and for the time of expiration. So if we continue to go the expected move, I still will be able to make around $26,000. You know, I still be making around 80% of my original trade, doing a couple of adjustments. But I can still do a lot of things. So let's say I'm not sure what's gonna happen or it's gonna stay around here. I can now sell a put. So for example, let's say with 61 days now, I could, let's say I wanna sell the 120. I could sell that one and sell 4, and now my max loss will be $10,000, and I will be capping my wins at $24,000. So now I will get in some time decay in my favor instead of the other way around, where the time decay is against me. And if I want even more time decay, I can even, let's say I do the 130. Again, now if it goes up, I'll be making $11,000. That's the less that I will be able to make. And if it goes down, my max win will be $21,000. This is the way that I believe it's better to short the market or any stock that you want. It's less risky, and you can manipulate your options so that you can reduce your risk. You can also make other trades around this position now and continue to improve it. Like, let's say you can do condors or put spreads or whatever you want to do to continue to get some cash flow with a position that is already guaranteed that you're not gonna lose money. And you can also use this thinking about the whole portfolio. So let's say I want to be bullish in other trades, but in this particular trade I'll keep it bearish. So in case there's in this bear market there's another big crash or something, then I am guaranteeing that at least I'm gonna make money in this one, even if I'm losing on the other trade that I am long. The good thing about this is that with the volatilities, there are gonna be huge moves to the upside or huge moves to the downside. So every time you get a big move in your favor, you can basically just take advantage and reduce your risk every time you get a move in your favor. So hopefully this was helpful. If you like it, don't forget to subscribe and hit the like button. If you have any questions, just put it in the comment. I'll do my best to answer them. Thank you very much and take care. Bye.